Hi, good morning everyone. My name is Ram Dhamija. Welcome to my channel. Today is 23rd of March and it's been a very smart recovery that the markets have seen for the last 10-15 days. When we were actually starting off with March, it was continuous 5 month of fall in Nifty, something that had not been seen since, if I'm not wrong, 1996. So it was a very painful period for most of the market participants, especially the ones who came in 2024, because 5 continuous months of fall will ensure that most of the portfolios which were made over the last 1.5 years would have turned into negative. And that is where the risk of investing during the peak of a bull run comes in. And that is where, the value of diversification, the value of hedging is known to a lot of people who don't understand these concepts. But having said that, the last 15 days, 10-15 days have been very good. Market has staged a very, very sharp comeback. And people who were not investing in the markets when the markets were going down would have found it very, very difficult to catch this up move. And this is typically what happens if one is not very disciplined while investing, if one doesn't have systems while investing, then you tend to miss out on the upside, because by the time where you realize that it was a good time to buy during that fall, the market has already run up quite sharply. So if I take the case of small cap, if I take the case of mid cap, if I take the case of momentum alpha, a lot of these indices are now already up 15% in the last 10-12 days. 15%, yes, you heard me right. So this is the power of the markets, that when they actually turn, they don't let anyone inside as well. So hence it is very, very important to have a correct system in place, which ensures that you are investing as per your system. So let's say people have a lot of systems that if the market is going to fall by one standard deviation, then they are going to enter, let's say, X percentage of their capital, or whatever. You might have a system in terms of valuation, you might have a system in terms of time correction, but whatever it is, if you have a set system, if you're following a rule based investing, then you are more likely to do much better than people who just invest on pure emotions. Because when the market is falling down, it is very, very difficult to also enter. Like, you don't know whether 21,800 was the bottom, or at that point in time there were talks that Nifty can go to 20,000 also. So people were anticipating, oh, everything is going wrong in the world, there are going to be tariffs and wars and this and that. So 21,800 is just probably a intermediate bottom, and so all sorts of things will come in. It's only when you have a system in place which says that, okay, now Nifty has fallen 15%, I'm going to put in 5% or 10% of my capital right now. If it falls another 10%, I'm going to put another 10%, and so on. Because in terms of our fundamentals, there was nothing wrong in the markets, in Indian markets, except for the valuation, which have corrected a lot now. And not only Nifty, but a lot of other indices have corrected, had corrected rather 35% from the top. 35%. That's usually reserved for when there is a crisis. So if there is no crisis, and if the indexes are giving you that kind of retracement, then definitely one should consider investing if your system, if your understanding tells you that yes, this is a good time to buy. So so we can only say these things in hindsight. No one knew that 21,800 was the bottom, or 21,000 is going to be the bottom, or 20,500 is going to be the bottom, or the election day low is going to the bottom. No one knows that. But what we know is that when the risk reward turns favorable, it is time to invest. And that is what I had been telling all my clients, and also especially on my video series as well, that please do not waste any opportunity, any correction. You can just see my last 15 days video. Every day I've been coming on and saying that we should never waste a bear market. So having said that, now where we are and how is the market looking, I'll take you through that, and then we will discuss what can we do during right now, what are the opportunities that are available right now. So let's start off. Now, as you can see, this is the Nifty one-day chart over here, and look at this smart recovery that you're seeing over here. This Nifty has already now crossed 23,000, and it made a high of almost 23,384, which is close to 23,400. Now, who would have imagined this, that on March 4th we were sitting at 21,900 odd, and on March 21st we are sitting on 23,300. So this is the power of markets, and this is what I've said. When the markets actually move, you'll just look at this: 1, 2, 3, 4, 5, 5 big green candles, 2 gap ups, and we have already covered 1500 points from the bottom. So this is the power of markets. And similarly, if you look at it over here, in February 5th, the fall started: 1, 2, 3, 4, 5 sharp candles, and again you are down 1200 points. So this is how the sharp movements of the market are going to be. You are neither will be able to catch the bottom nor the top. But what is important is that you realize that when the market gives you a good opportunity, you should invest. Okay. And now what is the next significant level where Nifty can test some resistances? First is going to be 23,800, and the next is going to be 24,200. Now I've been maintaining these two levels as the intermediate highs, because when Nifty is coming out of a bear market, then it is going to make, firstly it is going to try and going to make a higher high and higher low. That will be the first sign that this bear market is slowing down or ending, right? But till that time that happens, we cannot say that this bear market is over. Now one good thing was that the sloping line that you see, which is the lower highs lower lows line connecting all the tops, we have at least managed to cross this line. So that's a good indication, right? The first one was of course this 22,700. This was the first major resistance. We crossed that. Then the sloping line is down. So this gives us an indication that there is perhaps some strength in the market, which the market is not willing to give up right now. And what are the reasons for that? The reasons for that as well will be that the FIs also have started to turn net buyer. So that's also another good thing. Now let us look at how the performance of the market has been over last 1 week, 1 month, YTD, 1 year and 3 years. Now you look at it as 1 week, small cap index is given a return of 8%. In 1 week it is given a return of 8%. In 1 month 5%, but YTD it is still negative 15%. Right, same is the case with mid cap. 1 week 7%. Now how on earth will anyone be able to catch these kind of moves unless you have been investing steadily, right? And similarly, public sector enterprise, which was the most beaten down, is up 7%. Pharma is up 6%, right? Autos 5%, financial services 5%, banks 5%. Only IT is the one that is down, and India VIX, which is IT is down on a monthly basis, and India VIX is down on a weekly, daily, monthly, all basis. So where is Nifty? Nifty is about 4%. It is given in the last 1 week. I believe it is one of the best weekly performances after a long time. However, YTD it is still down 1%, and on a yearly basis it is given 5.6%. Now you look at it as 3 years, it's still 35%, which is very, very handsome. But I was just looking at the data for last 10 years, and it is given about 11%. So this is 11% is what you're going to get through Nifty, right? More or less. The alpha that comes in the markets is mostly in the small and mid caps. So one has to know how to invest in these particular indices, because they also are highly volatile, right? But the point over here to note is that whenever the recovery will happen, it is going to be like this: 8% a week, 7% a week, and this would also be followed by probably a huge up move. So you will see that very soon. Now this small cap, as you can see, minus 14 at one point in time, this had gone to almost minus 25%, right, from the top, and that is where the huge panic set in. So during it is during those panic times only that people who have a system in place are able to buy it. Now coming to how the indices are from their 52 weeks high. Now you can see over here, Fin Nifty is almost only 2% away, 2.5% away from its 52 week high. That is phenomenal, right? Market is down 11%, Fin Nifty is almost closing. Now that is because financials have done very well. They haven't fallen much, and the recovery has been very smart. So some names are already making 52 week high in the Fin Nifty. Now Nifty Bank is down minus 7%. Pharma is down minus 9.5, metals is down minus 10.4. So all these 1, 2, 3, 4, 5 indices that you're seeing are doing better than Nifty, right? The reason could be varied, that they actually rose lesser than Nifty, and hence they fell less, or it could be that inherent strength in them. So we will only come to know. Mid cap index is down minus 15%. Nifty next is down minus 20%. BSE small cap is down minus 18%. And then we have the weak indices like Alpha right now is at minus 25. Momentum. So momentum is doing very badly, and that is but expected in a bear run. That momentum is the one that suffers, but momentum will outperform when the bull market comes. So that is the nature of momentum. Okay, I had shared something interesting on Twitter. This was a graph that I had put. This was from a Twitter handle of Rajkumar. Now, if you look at how the basic mutual funds have performed, okay, in each category from their COVID bottom. Now, if you remember, 23rd March 2020 was the low when the COVID low that was made. From there, how has the performance been over the last 5 years and over the last 6 months? So the important thing to see over here is that in the last 6 months there has been a steep fall. But in spite of that, if you look at the 5-year performance, this is how the performance has been, and this is all CAGRs. Okay, now you look at small cap fund CAGRs, 5 years has been 33%. Okay, so from the COVID bottoms, of course, it is no one can actually catch the bottom, but if you the point to note over here is that if you invest when there is peak fear in the market, then the returns are also very, very good. So for example, you can see small cap has given a return of 33%, autos 30%. Okay, contra funds 29%, value funds 27%, large and mid cap 25%, flexi cap funds have even given 23%, FMCG has given 23%. So banking has given 21%, and this is all after a fall of almost 10 to 20% fall, right? So autos after falling 20% from the top also are still giving 30% CAGR. Small cap after falling 17% from the top are still giving 33%. So the point to note over here is that whenever there is excess fear in the markets, okay, it is always a good time to invest. Now let us look at how things are moving going ahead. So this, if you see over here, this is the things are stacked up for the next week. So this is the put call ratio chart for Nifty. Now you can see that the PCR is at 1.1 for next week. So things are all right. Things are looking fair right now as we speak. And in terms of the premiums also, the straddle premium is at 247, which is not very high, but it is okay. We will take this kind of premium as well. And if you look at the world market Qs, how are the Qs stacked up? So S&P VIX has cooled down for a bit, which is a good sign. And the Nasdaq 100 and Nasdaq 100 futures both closed in the green, so which is good. Bitcoin is holding at 84,000. US dollar index is at 104. It had gone to 103.8, but 104 is okay. Anything below 105 is fine as of now. Brent oil is again slightly climbing up, I think because of the news in the Middle East, but 72, below 75 it is still okay. Our currency is the main important one. So currency is now at 85.9, which is great. Now, a lot of you might be wondering that, okay, if I had invested in the US market, then, I would have outperformed. Now, look at what has happened over the last 1 month. US markets have corrected almost 10%. Dollar has gone down and Indian markets have gone up. So you can see within a span of 1 month only how things have turned. Indian market was correcting and US market was making new all-time high. Now suddenly things have reversed. So it is very important to maintain an asset allocation, maintain equity exposure across geographies, across asset classes, also invest in gold, so that whenever one asset class is rallying, you are completely hedged and protected. So for example, during all this crash that was happening, gold was doing so well. Gold is still at an all-time high. So if anyone had 10-15% of their portfolio in gold, they would have felt the pain lesser of the equity markets falling. So it is very important to maintain that asset allocation and maintain exposure across all asset classes. Only then your journey towards increasing your wealth is going to be more sustainable and more palatable, right? And I have been advocating 10 to 15% allocation to gold, 10 to 15% allocation to international equities. Then within the equities, Indian equities, how your allocation should be done, there are various ways and models to go about it. And in case anyone is interested, I am a mutual fund distributor as well. I am a NASM certified AMFI registered mutual fund distributor. I help clients make their portfolio in a very, very structured way. If anyone is interested, please fill up the Google form on the description below, and I shall get in touch with you. There is no charge, no fees for my services because I'm a mutual fund distributor. So I help clients make very solid, good mutual fund portfolios. So coming back to the point, your equity allocation should also be such that you are exposed across market cap indices, for example, small, mid, large cap. You should be exposed across factor indices like momentum, alpha, quality, value, and of course, as I have already said, across international and gold, and if you are invested in real estate, of course, that falls outside stock market, but that's also a hedge. So it's only when you have a well-rounded portfolio, when you have rebalancing in your portfolio, is when you can get the best risk adjusted returns, which will be very smooth in terms of your increase in net worth. So that is how one should go about making their portfolios, and I have shown it by various examples over the last 2-3 months, that how a well diversified portfolio is so much better than just having a concentrated exposure in, let's say, a small cap or a mid cap. I have come across clients portfolios which are heavily invested only in small caps, and trust me, a lot of those portfolios are down 30-40% with names which have very little chance of recovery also, because in those names promoters are selling, there has been some fraud detected, etc., etc. So my suggestion to retail clients is always, please stay away from investing directly in small caps. There is too much information that is not known for people to invest. And another mistake that people make is they go all in. They go all in into 3-4 stocks. They'll put all their net worth into 3-4 stocks, 5 stocks, 10 stocks, and they think that is good enough diversification. In my opinion, it is not. If you are investing in 10 mutual funds, yes, I would agree it is good diversification, because those 10 mutual funds are invested across 25 stocks each. So fine, you are invested across all market caps, etc. But just investing in 5 stocks, 4 stocks, having a very concentrated portfolio is not very advisable. So that's it from me now. This was a small update from my side. Things are looking fine as of now. Of course, there is no guarantee that the markets are not going to pull back. They might pull back any point in time, because US markets are under pressure. So if markets pull back, I would say it will be a good opportunity. But after 5 months of relentless fall, I don't see right now any big pullback happening, especially because the last week of March is also, people are winding up their positions, etc. So no one is taking very aggressive bets right now. So at least for the next 1 week, I foresee that we are going to be in a range with a positive bias, and come April we will take it from there. But markets do take a breather, they just don't fall in one line. But having said that, till the time we cross certain levels which we have already discussed, like 24,200, 23,800, we really cannot say that this bear phase is over. But having said that, please use all the opportunities to rebuild your portfolio, to build your portfolio sensibly, and to restructure your portfolio, so that when the next bull run comes, whenever that is, maybe it's 6 months, 8 months, 12 months down the line, whenever the next bull run starts, you benefit the maximum from it, and you actually genuinely end up creating long-term wealth for yourself. So that's it from me now, and if you like my channel, please do subscribe to it. If Please do share it with your friends and family on your WhatsApp groups, and please do leave your comments. I like to read your comments as well. Please tell me how your year has been, how your journey has been, and if you have any queries, please fill up the Google form, and I shall see you soon. Have a nice day, have a nice weekend. Bye bye.